They just killed the $60 to $70 and done idea. That range is finished. The tape is saying something louder now. Silver isn't topping. It's loading. And if one trigger snaps, the next couple quarters could take silver into triple digits, then keep climbing. $100, $150s, even flirting with $200. Sounds crazy. Here's what's crazier. What the market has done for 50 years. Gold escaped its old ceiling. Twice. Copper escaped. Lead escaped. Whole commodity worlds moved into new realities. Silver? Silver has been sitting in the same box like someone welded the door shut. So we need to ask the only question that matters. Is silver actually stuck? Or has the market been wrong for decades and we're minutes from the correction? Now watch this. Fact. After gold was re-legalized in the mid-1970s, it didn't politely drift upward. It surged, snapped back, built a long base, then surged again. What that means, when a monetary metal changes regimes, it doesn't behave like a stock. It behaves like a pressure valve. And on a clean long-term chart, gold has already done that pressure release cycle more than once. First wave, from roughly $100-ish lows in the 1970s to the 1980 spike near $850. Second wave, from the early 2000s low zone in the 200s to the 2011 peak around $1,900. Two massive waves, two new reality zones. And here's a detail people skip because it sounds too technical, but it changes how you feel the move. Most charts you see on social media are arithmetic charts, straight lines, equal dollars on the axis. They're fine. But when you zoom out across decades, what matters is the rate of change, not just the absolute dollars. That's why traders use ratio and logarithmic thinking on long cycles. Because a move from $200 to $800 is not the same as a move from $2,000 to $2,600, even though both are $600. One is a 4x, the other is barely a 1. 3x. So when we compare gold's prior surges to this current one, the surprising part is not that gold is high. The surprising part is that on a long cycle strength basis, gold hasn't even matched the intensity of its earlier bull waves yet. That doesn't mean gold must do the exact same thing again. It means the "it's already over" crowd is arguing from the wrong measuring stick. And if gold still has regime change energy, silver being trapped becomes even more absurd, because silver isn't just a smaller gold. Silver is the metal that historically sleeps and then tries to catch up in a single season. That's the personality of the beast, and it's why the box matters so much. A box isn't just a price range. A box is a belief system. It's the market telling you, month after month, nothing new is allowed. Until the month it breaks that rule. And when it breaks, the first thing that happens isn't euphoria, it's confusion. People don't celebrate a breakout at first. They argue with it. They call it a fake out. They say it's overextended. They wait for permission. And by the time permission arrives, price has already sprinted. And today, gold is sitting far above the 2011 world. So why does silver look like it missed the entire party? Let's pause here, because this is where most people blow it. They look at silver and say, it's boring, it's dead, it never moves. But markets don't stay boring forever. They stay boring until the day they aren't. And when they wake up, they don't stretch. They sprint. We've watched this exact movie in metals nobody even talks about at parties. Copper, lead. Yeah, lead. For decades, copper sat in a tight range like silver does now. Then around 2005 to 2006, copper didn't gradually improve. It detonated. It roughly quadrupled in a short window and left its old range like it never existed. After that, a whole new price world, a whole new middle. Same with lead, multi-decade box. Then 2007, boom. It ripped higher on its own timing. Not synced, not convenient, not gentle. It created a new normal way above the old normal. Now, let's get honest about why these breakouts feel like magic. They aren't magic. They're crowd mechanics. A long range builds two things at the same time. It builds boredom, and it builds trapped positioning. Boredom makes people leave. Trapped positioning makes the eventual move violent, because the moment price exits the range, everyone who has been fading the ceiling suddenly realizes they're standing in front of a moving truck. And here's why the multi-decade part matters. A short range might only trap short-term traders. A multi-decade range traps generations of opinions. It traps analysts who built careers calling silver dead money. It traps fund managers who underweighted it because it never behaves. It traps algorithms trained on decades of mean reversion. So when the ceiling breaks, it's not just a trade, it's a public humiliation. The market forces an apology, and apologies in markets are paid in candles. That's why copper didn't need years. That's why lead didn't need a committee meeting. It needed a break. And once it broke, the old world became irrelevant. Silver has the same shape on the page. The The only question is timing. So here's the contradiction that should make your brain itch. If copper and lead can break out of decades-long cages, if gold can do it twice, how is silver still hovering near where it was in 1980? Fact, silver printed about $50 in 1980. Fact, silver is still hanging around that neighborhood decades later. What that means, that's not normal. That's a distortion. Call it suppression. Call it neglect. Call it positioning. Call it a decades-long blind spot. But we can't fake gravity forever. Sooner or later, price has to reconcile with reality. And here's the part most people forget. Markets don't only make mistakes on the upside, they make mistakes on the downside too. You've seen bubbles. When they pop, you look back and it's obvious. Irrational too high for too long. But the downside version is quieter, and it fools smarter people. A market can stay irrationally cheap for years. Nobody loves it. Nobody talks about it. No one wants to hold it because it does nothing. Then, one day it snaps, and you don't get a gentle invitation. You get a thunderbolt. So what are we seeing now? We're seeing measurable setup, not vibes, that silver is near the edge of one of those thunderbolts. And we're not hanging this on gut feel. We're hanging it on triggers we can track. Now, if we're wrong, where will it show first? It will show at the trigger, because the trigger is the line between still trapped and new reality. We need to watch that line like hawks, and we need to be clear about what trigger means, because this is where people get chopped up. A trigger is not an intraday spike. A trigger is not a headline. A trigger is a close that sticks. Markets love to tease you inside the month. They'll rip above a level on Tuesday, dump it on Thursday, and leave you with emotional whiplash. That's how they shake out weak hands. So we don't worship the 5-minute chart. We watch the monthly close, because the monthly close is where institutions keep score. It's the difference between noise and regime. If silver pushes above the line and closes the month there, that's the market signing its name on the move. And once a long-term ceiling flips into a floor, a weird thing happens. Every pullback becomes a buy the dip event. Not because of hype, because the breakout changes who is forced to act. Shorts get trapped. Underallocated funds get pressured. Trend systems flip from sell to buy. That's why the move can speed up like a snowball rolling downhill. Now, does that guarantee triple digits? No. It just means the upside path opens wide enough that triple digits becomes a realistic destination, not a fantasy. And if we're wrong, the close tells us quickly. That's the beauty of a measured setup. And once it breaks, the pace changes, not over years, over quarters. That's the whole point. And the reason it matters for you is simple. If the move happens fast, most people won't position in time. They'll chase, they'll buy the headline, they'll buy after the first 30% candle, then swear they missed it. We don't want that. We're not gambling, we're measuring. Here's the psychological trap with long consolidations. 50 years of a box trains the brain to think the box is permanent. It's like a prison where the inmates stop testing the door. But the market isn't a prison, it's a spring. The longer you compress a spring, the more violent the release when it finally releases. And here's what Wall Street hates. Long compressions don't end with a slow drift. They end with a shock. So when we hear maybe silver can go to $60 or $70, we need to ask, based on what? Because $60 to $70 is the kind of target people say when they're still mentally trapped inside the old box. But if silver's about to do what copper and lead did, leave an old world, then the target isn't a little higher. The target is a different reality. And different reality moves look like this. Price doesn't just break resistance, it breaks belief. Okay, but we stay credible. Certain. Silver has been boxed for decades on long-term charts. Certain. Other metals have broken similar multi-decade ranges and quadrupled quickly once the break happened. Likely, if silver breaks its own structural ceiling, it has room to run hard because there's less recent overhead supply to choke it. Possible. The move overshoots to levels that sound laughable today because re-rating phases love to overshoot. And yes, this is educational. We manage risk. Now here's where it gets interesting. Even if you believe silver can run, there's a second layer that almost no one respects enough. The silver miners. Right now, they're the dogs of the precious metals family. Gold miners have already started acting like they remember how to move. They pushed back toward old highs fast. They basically shouted, "We're back." But silver miners? They're still lagging like the market doesn't believe silver has a pulse. And that lag is fuel, because in a true silver tantrum move, when silver goes vertical, miners often act like leveraged versions of the metal. Why? You're not buying a bar. You're buying a machine that produces bars. And when the selling price rises faster than costs, profits can explode. Now watch this. If silver goes from $50 to $100, that's a double. But for a miner whose costs don't double, profit can multiply far more than 2. That's operating leverage. And when the market finally prices that leverage, the repricing can be violent. But we also need to avoid the rookie trap. Not every miner is silver exposure. Some hedge away upside. Some are basically base metal companies with a silver side hustle. Some sit in jurisdictions where the rules change when prices get exciting. So we ask the adult questions. Does the company live and die by silver? Is it largely unhedged? Are costs stable enough that higher silver actually drops to the bottom line? We don't need to guess. We can read their filings and see if they sold tomorrow's silver at yesterday's prices. And this matters because the wrong pick won't just underperform. It can disappoint so hard it breaks your confidence right when the metal is running. That's how people sabotage themselves. We don't do that. We want clean exposure to the move we're measuring. Now let's zoom out again. We're not saying silver will definitely hit $200. No fake confidence. We're saying a measurable setup exists that has historically preceded explosive phases. If the triggers confirm, the upside case strengthens fast. If they don't, we step back. That's discipline. Now hold this open loop in your head. Sometimes the ratio trigger confirms after the first blast, not before, meaning the first rip can happen while everyone is still arguing. That's why breakouts feel unfair. By the time the crowd agrees, the easy money is already gone. So ask yourself this. Do you want to be early and slightly uncomfortable? Or late and emotionally forced? Now we bring in one more relationship people ignore when they get hypnotized by daily candles, gold versus the stock market. When gold starts outperforming broad stocks on a long time frame, it's not just gold up. It's capital changing its mind. It's money choosing safety over hype. And that shift doesn't happen for a week. It happens for cycles. On some broad comparisons, gold already looks like it's breaking free. On the headline index, it's closer, held back by a small handful of megastocks that drag the whole index. But on broader measures, the shift looks more advanced. So what does that suggest? It suggests the stocks forever story is cracking. And when that story cracks, monetary metals usually get another wind at their back. And silver, because it's the laggard, often becomes the catch-up trade that shocks everyone. That's why we keep circling the same uncomfortable truth. If gold is rewriting its regime, silver can't stay frozen forever. Not without the market admitting it's been wrong for decades. And markets hate admitting they're wrong. They prefer a violent correction. Now the fuse. There's also a simple momentum gauge on that ratio that we watch like a heartbeat. Think of it like this. Take the silver to gold relationship and compare it to its own 10-month average. When that momentum line can't break above its prior peaks, silver stays the junior partner. But when it finally breaks, it's the first sign the engine is revving. And right now it's close enough that one stubborn month can do it. That's why this setup feels tense. It's not far away. It's right on the edge. The silver to gold relationship, silver as a percentage of gold. Right now it's low, meaning silver is cheap relative to gold by many historical standards. And there's a ceiling that's been capping that relationship. A monthly close above the mid-1, 3% zone. That's the line. If the ratio closes above it, the message is simple. Silver is no longer just moving with gold. Silver is beating gold. And when silver beats gold in a precious metals bull, it doesn't do it politely. It does it brutally. Now think. If gold has marched far ahead and silver starts beating it, where does silver have to go to close that gap? That's where triple digits stop sounding like a meme and start sounding like a math problem. And here's the sneaky part. Silver can be rising and still underperform gold. That's why price charts alone can lull people to sleep. The ratio breakout is the cue that the final act has started. So the real question isn't, is silver up? The real question is silver about to go faster than gold? Because that's when we stop thinking in $10 increments and start thinking in multiples. Now, one more retention beat, because the next clue is what people miss. These breakouts don't need a decade. They need a close. Sometimes it's a hair's breadth. 1 month where silver refuses to underperform. 1 month where buyers stay stubborn. And then the ceiling becomes the floor. And once that happens, the crowd that ignored silver for years will suddenly pretend they always loved it. You've seen that behavior. They'll talk like it was obvious. It won't feel obvious before it happens. That's the edge. If you're here for real signals, stay with us and don't blink. If you want to track this with us without missing the trigger, hit subscribe. Short, simple. You'll know when the line breaks. And I want you in the comments. Do you think this 50-year silver box is manipulation? Or just the biggest market mispricing of our lifetime? And if the ratio breaks that ceiling, what do you think the crowd chases first? Physical silver or the miners? Now the final warning. When this move starts, your first instinct will be to doubt it. Your second instinct will be to wait for a pullback. Your third instinct, if it keeps running, will be to panic buy. That emotional sequence is how most people lose. So we do the opposite. We define the triggers now while it's quiet. We decide our risk now while the screen is calm. Because once silver starts moving like copper did, you won't get time to think. And the wildest part, the market doesn't need everyone to believe. It only needs the door to crack. So keep your eyes on the monthly closes. Keep your eyes on the ratio ceiling. Keep your eyes on the miners for the first sign of leadership. Because if we're right, the new reality won't arrive with a warning. It'll arrive as a sudden repricing that makes today's debate look small. And if we're wrong, we'll see it at the line, and we step back. Measured, not emotional. One last thought. The biggest moves don't start with celebration. They start with disbelief. They start with people saying, no way. And then, quietly, the door opens. We're standing in front of that door. Now, the only question is, what happens on the next monthly close when the crowd is still asleep?